is our moderator. He is Rohit Sipahimalani, the Chief Investment Strategist at Temasek. Thank you so very much, sir. And joining us virtually, we have Stephanie von Friedberg. She is the Senior Vice President for Operations at the International Finance Corporation. We also have Philip Hildebrand, who is the Vice Chairman, of course, of BlackRock. And we also have Haslinda Amin, who is the Anchor and Chief International Correspondent for Southeast Asia in Bloomberg. All right, Haslinda, apparently you are moderating this discussion. Yes, I know you were sweating a little bit, weren't you? Thinking you were going to moderate. Don't worry, just kidding. All right, thank you very much. Haslinda, over to you.
Thank you so much for that. And thank you, everyone, for joining us from wherever you are. Now, COVID-19 has further exposed the shortcomings and risks to the global economy, prompting calls for governments and companies to build back better, taking into account climate sustainability goals. Some 1,500 companies have made net zero pledges, including financial institutions managing $88 trillion. That's a third of global financial assets. Now, as we look at building the post-pandemic world, what opportunities, what trends should investors look out for? How should they plug the gaps created by the pandemic in the transition to a net zero world? As you heard earlier, we have expert speakers with us. Philip, let's start with you. There is no standard definition of what makes an investment sustainable. That means asset managers are able to cherry pick what fits them. What's your take on that? How do you define at BlackRock what is sustainable?
It's a critical question, and I'm glad you start with it. At the same time, I think it's important, we need to act, even though we know there are issues around standardization, data, and analytics. So we should always say up front that this problem that you rightly identify should not stop from capital flowing. The way it works in practice, you try to create choice as an asset manager. We're a very large asset manager. We have a large index business, so that's constrained in many ways by the index providers, who are, by the way, also moving very rapidly to change the indices towards being more sustainable. And so I think the key is a combination of more choice and transparency. The way you deal with the lack of a global clear standard as to what is sustainable is you try to be as transparent as possible in the way you produce the new products, in your product innovation, by laying it out clearly to the client what he or she is getting in terms of the sustainable version of a particular product. So I'll give you an example. We have a large sustainable ETF suite. Each of these ETFs is very transparently on the website. You can see exactly what's the reduction of CO2 emission, what's the upgrade of other S&G factors involved. So I think this is the way we have to kind of move towards a world where slowly, hopefully, these standards will converge. The second thing we all need to do, I believe, is to continuously remind governments that they have the primary job to do here. I think it's very important to say this up front, that the financial market has an important role to play, can be a catalyst for positive change, but we cannot be the police force globally to bring us to net zero. At the outset of all this, there has to be a clear set of incentives, parameters set by clear, unequivocal government policy that sets the main path towards net zero within which we can then operate. So I think it's the combination of feeling our way into it, being transparent, being upfront with product innovation, and continuously insisting that governments do their job in terms of setting out the pathway.
Transparency, exactly the problem, but we'll pick on that slightly later. Rohit, I want to bring you into this discussion. When it comes to Temasek, it says it is committed to net zero, but it's made clear it is not saying no to carbon emitters. It is open to investing in companies as long as they have a green journey. Talk us through the thinking behind that.
Well, firstly, I'd like to make the point that our mandate is to achieve long-term sustainable returns. So sustainability is at the core of, I would say, pretty much everything that we do. And environmental sustainability is a big part of that. Now, a big part of our focus there is to invest in new technologies, which we think are going to be critical to get to a net zero world, or even a 1.5 degree world. And to be able to do that, therefore, we've set up this joint venture, for example, with BlackRock to focus on these technologies. Now, while we are doing that, we also recognize that there is a large part of the world that today are emitters, and we need their products and services. And they're looking to make a transition, and they will need to make a transition to more sustainable technologies to reduce their emissions. And we think we can play a catalytic role out there. For example, we've been an anchor investor in a fund that Brookfield is setting up exactly to do that, to look to see how we can work with companies who are looking to make that transition. And frankly, I would say that whereas market is valuing some of the sustainable companies or these new technologies very, very highly, there are a lot of these traditional companies who are emitters today that are actually not being favorably looked at the market. So we actually feel that if we could work with them on their decarbonization journey, there's actually a lot of value to be created, while at the same time doing a lot of good to the environment.
It does matter where they are on their journey, and we'll continue that discussion. Stephanie, the financial sector plays a key role in the transition to net zero. Are we seeing much progress in the green and sustainable finance sector, both in terms of regulation and investment, as well as financing trends?
Haslinda, it's a great question, and I fully agree that financial services are at the core of what we're doing, especially the commercial banks. I mean, I take us back to just remembering that from the smallest formalized SME to the largest, multinational corporations in the world, they're all banked by commercial banks. That provides us leverage. You mentioned the 1,500 companies that have all committed to net zero. But in the conversations I'm having with their leaders, the question they're saying is, how do we even start? How do we get there? And we invest solely in emerging markets. Only 10% of the commercial financing we see is green. So I think it goes. We need a push and a pull strategy. And the first is really around policy and regulation. And Philip touched on this lightly, but we need to help countries and regulators create taxonomies we all understand, so we know what we're investing in. Then we need to create reporting and disclosure policies that force people to show what they're actually doing. I think over time, this will push shareholders and stakeholders to get corporations to do the right thing. Then we need to really think about how do we create innovative products. So green bonds, the World Bank issued the first green bond in 2008, and green bonds have been growing very rapidly. But we created two funds, the EGO Fund and the Regio Fund, really designed to get at the supply and demand of green bonds. Then there's blue bonds, blue loans, very nascent, but a lot can come out of that. We recently did an investment with Indorama to help them pull 50 million plastic bottles out of the ocean by 2025. We've talked a little bit about sustainability, but sustainability-linked instruments I also think are very interesting, because they're not forcing companies to lean into blue or green, but much to what Rohit was saying, it's actually putting leadership and management in those institutions on a better path for ESG. And in exchange, if they meet KPIs and targets, we can actually reduce spread. And finally, and we actually just issued, by the way, a very big bond, anchored a bond for Sembcorp to do exactly this. Very exciting. And finally, the London Stock Exchange just announced what they call transition bonds, which, again, to Rohit's point, is really getting at how do we edge companies to create a plan to get to net zero by 2050. And we need to use instruments through financial institutions to do that.
The thing is, Philip, we are running out of time. We had the UN say recently that it is code red for humanity. We have to slow climate change quickly. The business world, the financial world has not come far enough to track emissions across the supply chain. So there is a need to be more ambitious in the targets.
Sorry, is that a question for me?
It is, Philip.
Okay, sorry. Look, I think there is a lot of capital available that sees the opportunity out here. People recognize, societies recognize that, and governments have recognized that we need to act now to tackle the climate problem. You're seeing more and more forest fires, you're seeing floods, you're seeing droughts, you're seeing adverse weather conditions. And even while regulators are trying to figure out what to do about it, governments trying to figure out what regulations to have around that, you have providers of capital, you have customers, you have employees that are sort of asking companies to be accountable. And that is what is creating a significant business opportunity. There's a lot of capital available to move towards a decarbonized world. And in fact, that's one of the things that's really driven up valuations of a lot of these companies. So I don't think capital is a constraint today. In fact, we've identified 7 areas within the broad theme of sustainable living where we see huge opportunities. They include food, water, waste, energy, materials, mobility, and urban living. And whereas, as I mentioned earlier, there is a lot of opportunity in startups, but there's a lot of opportunity also with established companies who can make that transition, and the capital is available. But as was mentioned both by Philip and by Stephanie, you need regulation to be able to accelerate this change. It took 30 years for us to get to competitive price parity for solar and wind energy. We don't have the time to do that. And that's why we need the support. I don't think capital is a constraint today.
So, Philip, the way forward is mandatory disclosures. I mean, we're hearing from the SEC's Gary Gensler talking about just that.
Yes, and I think it's governments need to back up. We've come a long way. They have committed to net zero. Many governments, including the most important ones. That's an important first step, which started moving the capital, as Rohit has mentioned. But what is required now is specificity. Are they going to do it through directives on standards? Are they going to do it through carbon taxes? Are they going to do it through regulation? This needs to be specified so that we can unleash this capital. As Rohit said, there's plenty of capital. The world is awash in money right now, looking for places to invest. As much of the fixed income world is in negative rate territory. So the opportunities are there, the capital is there, but in order for that flow to happen in the kind of size that is required, we need clarity and commitment by governments as to how they're going to impose the pathway to net zero in specific jurisdictions. If we don't have a clearly set out pathway, we're still going to be sitting here 2 years from now saying there's lots of opportunities, lots of capital. In principle, the returns are here, but the money won't be flowing. And remember, the magnitude of investments required for this, for us to get to net zero, is enormous. We're talking about trillions of dollars per year. So no matter how much money comes from the public sector, that can be, again, an important catalyst. It can be an incentivization, especially if it has certain first loss protection elements to it. But at the end of the day, no fiscal policy from the public sector will be enough to cover the trillions of dollars that will be required for many, many years to come to get us to net zero. That's why I think this laying out the pathway through specific government measures is going to be critical to make the money move. We can't escape climate change. We're either going to have to deal with the transition risk. That's what Rohit mentioned. So companies will have to change. We're going to see, wholesale change throughout the global economy. That's hard. If we don't do that, we're going to get the manifestation of physical risk increasingly, and it'll become ever more painful. So not kind of acting or not being affected by climate change is actually not an option. And I think recognizing that leads you pretty quickly to the outcome that it is better to focus on transition than simply to delay action and then be hit by increasing physical risk.
Stephanie? Your thoughts on that?
I certainly do. And I agree completely with Philip. The wearing the emerging markets lens, I would add a couple of things. We have been talking since Addis in 2015 about billions to trillions and the patient capital that's sitting on the sideline. How do we actually attract it to emerging markets? When I look at where's the lion's share of GHG emissions growth going to come in the next decade, it's in emerging markets. So there's an opportunity for us there to really play actively. And we need, again, I think we need 3 things. We've talked a lot about policy and regulation. The other piece of the policy and regulation we need to be looking at is where do we have incongruent policies? So it's very unhelpful for a country to have fuel subsidies and then try to drive renewable energy. So those kinds of things we need the public to be working on. Second, more than anything, we need projects. There is capital in the world. There's not enough projects. And what I see in our countries of operations is what I call a race to the bottom. So any of the development finance institutions who are trying to help these green projects get off the ground, they're all competing with one another. So we've actually created a strategy and are really trying to drive project development in our countries of operation because that will allow us to bring more capital. And finally, I think Philip mentioned some kind of de-risking capital. We do need money to do a couple of things. First, we need to buy down the cost of coal and the decommissioning of coal. That would make a huge difference to the world. And, you know, the coal plants in Asia that are 11 and 12 years old have a long life left. So how do we actually pool money? And I believe there's money out there, both public and private, that can be used for that. The other thing, we need to de-risk these projects with first loss. We need to find ways, as Rohit said, to drive down the cost curves on technology, because there's really interesting technology out there, but we don't have 30 years, which is what it took us to get solar to a point where, you know, we can do a solar project in Uzbekistan for, you know, $0.015 a kilowatt hour. So how do we do that in a logical fashion is where we really need to think about better use of public and private balance sheets to make that happen.
Before I forget, I would like the session to be interactive. So if you have a question, do submit it. I'll direct it to our speakers. Send your questions to pigeonholelive.at. That's www.pigeonhole.at. The password is ECO2021. That's ECO 2021. Now let's continue our discussion. We're talking about how the world is awash with money. The thing is, how do you deploy that capital? Rohit, from your perspective, what are the most exciting trends? What are the most exciting opportunities you see there?
So look, I mentioned these 7 broad areas that we are focused on. They're all very exciting. I mean, food, take for example, is one of the areas we've been investing in since 2015 in the area of plant-based proteins. And it's an area that's exploding. We were initially, our initial investments, we were not sure in terms of whether it would be cost competitive, but both in terms of costs and tastes, they've been sort of rapidly sort of coming to parity. So that's a huge area. So we've got plant-based meats. Now we're getting cell-based meat. We've got non-animal dairy. And all of this actually will have a huge impact on greenhouse emissions because cattle is a major source of emissions out there. So that's one huge opportunity out there. Secondly, when we talk about mobility, we've been talking about clearly electric vehicles. But there's a lot of things around both shipping and airlines in terms of whether it's sustainable aviation fuels, looking at green hydrogen to ultimately, you know, power different forms of transportation. These are, again, huge market segments out there. If you look at, what else? I mean, if you look at water, you know, water, again, that's going to be a major scarce resource. We've invested in drip irrigation companies, which actually we see huge potential for. So, I mean, the opportunities are endless. If you take materials, I mean, all the infrastructure we're looking to build, you know, you need a huge amount of steel, cement, all of which is very carbon intensive. We need to have decarbonized solutions for them. And again, there are technologies being developed, and you have incumbent players also working to sort of pledge that they're going to move to decarbonized versions of the existing materials. Again, that's a significant opportunity. So as I said, there's no shortage of opportunities, and I'm very, very confident that with the capital that's available, in fact, one interesting, just as an aside, with all the SPAC money that's out there, you know, the $120 billion that 400 SPACs are looking to spend in the next 12 to 18 months, a lot of them are also targeting this segment. So there's no real shortage of capital. And I think that will be moving in the right direction over the next couple of years. But we need the right regulatory incentives to make sure that these technologies can compete and scale up with the volume they need to get the cost down. Because if that doesn't happen and you have huge disappointments, I think it'll be a huge setback for us.
Philip, BlackRock manages about, what, $200 billion in sustainable investment strategies. You've said before that it is about understanding the interplay between public policy, technology, and finance. If you take that into consideration, if you factor that in, how best to ride this ESG boom?
I think the first thing to say here is I'm convinced we're only at the very beginning of a vast reallocation of capital into sustainability in all the areas that Rohit has just mentioned. You know, this is only the beginning. So this huge reallocation of capital will continue for many years to come, provided governments remain committed to actually following up on their general commitments to net zero. And that will, of course, mean that this is an opportunity. So investing in sustainability is an investment opportunity, and that generates lots of innovation, lots of new products. If I look at our own case, the pace of growth of our sustainable product offering is far outpacing the traditional offering. And, we certainly expect the sustainable part of BlackRock to grow very, very rapidly. In fact, we're convinced we're going to get to $1 trillion of sustainable assets pretty quickly. So far, a lot of the growth has been on the index side. That's been easier to implement. But very quickly, what we're now seeing is that the active space along the lines of what Rohit mentioned is beginning to move in terms of new products, new ideas, new innovation. Clients are following. So I think we're seeing a kind of coalescing of three forces actually. One is the manifestation of physical risk, which has been so dominant in the last couple of years. You can no longer deny that climate change is real. So this is the physical manifestation is creating an incentive. The second is that we're seeing the commitment by governments is there. Hopefully it'll get deeper. In Europe now, we expect that a few years from now, if you're not in the right category of the official sustainability labeling that is provided by the public sector, you're not going to be able to sell the funds, the mutual funds in Europe. So there's a very strong incentive in Europe to actually have all your products within the next few years being in the right article category, in other words, being sustainable. And then finally, I think the key piece is, we're coming around to the view, and the market is recognizing that this does not entail a trade-off in terms of returns. For many decades, the reason why sustainability was a niche piece of the investment industry, because it was based on the notion if you did that for moral reasons, for environmental reasons, you'd have to sacrifice some returns. What we're seeing, certainly on a risk-adjusted basis, that is simply no longer the case. And I think that's a very important change because that opens it up to mainstream, right? It is no longer niche. And I would expect with great confidence that we're going to see in our own case and in the market more broadly, we're going to see the sustainable piece growing very, very quickly in the years to come. What is needed is persistent and continued commitments by governments to actually lay out the pathway how to get to net zero.
The thing is, when it comes to emerging market governments, Stephanie, they're lamenting over the impossible challenge of climate change. Both adaptive and mitigating solutions are just way too costly. Is this a challenge or is this an opportunity? Which countries are leading the way? Where should capital be directed?
So, Haslinda, I said this earlier, it's both a challenge and an opportunity, but I see it more as an opportunity than a challenge. I would actually maybe pick up where Philippe left off. We finished last year a very interesting study with Harvard where on a risk-adjusted basis, we actually demonstrated that the 60 years of our private equity investing, we've outperformed the S&P. So we know that you can do good and you can do well. So, I actually believe there is a huge opportunity for us to be thinking about emerging markets. And I think there's opportunity in all emerging markets. They're very different kinds of opportunities. So we need to think about decarbonizing critical sectors. I think Rohit mentioned some of those in the more advanced emerging markets, places like China, India, Brazil. These are places where heavy manufacturing, we can introduce technologies like green hydrogen and begin to make different kinds of products. Then if you think about countries like Africa, where outside of South Africa, they only represent 4% of the greenhouse gas emissions, we need to think really differently about the kind of investment opportunities that exist there. We're going to need a lot more de-risking capital, and we actually have to find a way to help the energy poor on the continent of Africa get access to energy. Together with that, I think we need to focus on urbanization, huge opportunities around urban transport. I think Rohit talked a little bit about electric vehicles, but as the world urbanizes, and it's urbanizing rapidly, we have an opportunity to green cities, and you will see IFC making lots of investment in greening cities. And then, we've also, under our climate change action plan, committed to look at agribusiness. Rohit's right, really interesting opportunities in ag and ag tech. We actually recently invested in a company called Appeal. So the 45% of all the food that is actually grown in emerging markets is wasted from farm to table. And what Appeal does is actually extend the life of fruits and vegetables without refrigeration for up to a month. Those kinds of technologies are groundbreaking and transformational. And what we need to do is figure out how we take those really interesting technologies from the developed world and bring them to emerging markets as quickly and as cheaply as possible.
I want to touch on collaboration, PPP, but before that, Philip, this question is for you from one of our participants, from Darren Lean. And the question is, do you think that banks should work together to achieve their own sustainability goals, such as with the use of green bonds and green financing for better economic GDP growth?
Yes, absolutely. And I think the more they can do it with the industry, with the regulators in a comprehensive way to determine what is the right path, the better it's going to work. You know, shipping is a very good example. Shipping perhaps is a little easier because you have one global regulator, but there's been tremendous progress between the banks, the regulator, and the shipping industry to actually determine what is the appropriate pathway to net zero in shipping, which is an important sector. And as a result, it creates a blueprint for the kind of lending in the future from banks that would be in line with the transition goals to get to net zero. So I think it's a very good example, and similar discussions are beginning in other sectors to try to get all the stakeholders around the table and determine what is required. Maybe if I can just pick up one point on emerging markets, I think this is going to be key. If you look at where the electricity is going to have to come from by 2030, something like half the world's electricity is going to have to come or be produced in emerging markets. So what we do with the developing world is absolutely critical. And as you may know, Larry Fink has made some, I think, important statements at the G20 that we need to rethink the way the MDBs are thinking about incentivizing private capital to flow. We have simply not seen enough private capital go in, and I suspect unless we rethink the financial architecture and how you can bring in a system where, you know, we reduce some of the risk so the private capital can flow in the kind of scale that will be required, this is not going to work. So I think this rethinking the public sector's role in reducing risk and incentivizing private capital through the existing multilateral institutions is going to be a critical piece. We have tried to launch a small fund called the Climate Finance Partnership based on the same principle, where some of the risk is taken out by the governments that participated in this with a tranche of capital. And then we bring in foundations and private investor partners into the vehicle in order to fund clean infrastructure in developing countries. But unless you have some risk mitigating role that the public sector has to play here, I worry that this is a goal that we will not reach the kind of sums that will be required.
Let's talk about PPP collaboration. Rohit, where are the opportunities for PPP collaboration in green infrastructure, perhaps?
Look, we just spoke about emerging markets, right? And the key issue out there is very often it's a counterparty risk issue, and ability for companies and countries to be comfortable with counterparties, and the fact that contracts will be adhered to. Now, in the absence of that, it's very difficult for companies to come and make huge investments, particularly in infrastructure in emerging markets. And that's where probably the multilateral institutions can play a role by coming in, given their leverage with governments, by being a party to these projects and giving the private capital a little more comfort out there. By the way, I'm echoing the point that both Philippe and Stephanie made. I think one big risk we do have around this whole issue about climate change and addressing it is the fact that greening the world is going to be a very expensive task over the next few years. And it's going to be highly inflationary in that context. And particularly, therefore, in emerging markets, unless there is a way to sort of address that issue, there's a high risk that governments will not have the stomach to see through that. And that will really defeat the purpose in terms of what we're trying to achieve out here. So it's something that's very critical, but it does require, at one end, basically capital being made available, subsidies being available from the developed to the developing world, but also, as we talked about in terms of public-private partnerships, multilateral institutions coming together to help facilitate private capital come into these markets.
Stephanie, how are you approaching risks, regulatory risk, construction risk in emerging markets? I mean, not too long ago, private capital used to get really nervous about investing in long-term infrastructure development because there's just no guarantee on returns.
So it's an interesting question, Haslinda, and I think we have begun to use the balance sheets of the entire World Bank Group to help us solve this problem, especially in the poorest countries. So using partial risk guarantees from the IBRD or IDA balance sheet, having MEGA step in to de-risk some of the contractual issues that you may have with a government or a counterparty, as Rohit rightly said, has worked well for us. It's just not scalable in terms of what needs to be done to tackle climate change. So, you've heard us all talking about the patient capital that's sitting on the sidelines. I actually think what our job is as the interlocutor between public and private is to figure out what is it going to take to crowd that in. And I think one of the problems that we face is a lot of the patient capital that's sitting on the sidelines actually can't or is very reluctant to invest below investment grade. So how can we institutionally create pools of assets that would in essence be rateable for equivalent to triple B or better, that they would be willing to invest in? Does that mean offloading some assets from our balance sheet today that are already mature? Does it mean creating a platform that they will come along with us where they would have both our political protection through our privileges and immunities, as well as some of the de-risking tools that we can pull with us? I think that's one area we really need to consider, and it's something that we're working really closely on. I think the other area where we have overlooked so far, but will really help us get these projects done and get them de-risked, is actually private money. I have a sense that many of the companies that have committed to net zero, as I said in the very beginning, don't know how to get started. What they really need is carbon offsets of some kind to get moving. And I think we can tie the concept of their need for carbon offsets with what we're trying to do in emerging markets to actually put together at least a big enough pool of capital to begin to drive down GHG emissions in most of the countries in emerging markets.
In the end, for investors, it is about returns. Rohit, Philip touched on this line earlier. Is there really no conflict between investing in sustainability and returns?
We at Temasek, we do projections for our expected returns for the next 20 years, and we look at it under different scenarios. And we look at a high climate ambition scenario and a medium climate ambition scenario. And whereas in the short term, and by that I mean the next 5 to 10 years, returns in the high climate action scenario are marginally lower than in the medium action scenario. Over a 20-year period, actually you have higher returns under the high climate ambition scenario. And it's logical because you're going to see issues around physical risk and transition risk, et cetera, which are going to create problems for returns in the longer term. So yes, there is some trade-off in the very short term, but if you're looking at longer term returns, there clearly is no trade-off out there. And then from a practical perspective, look, every day companies are faced with this issue about physical risk and transition risk. And if they don't look to address that, it's going to be difficult for them to have sustainable returns over the long term. So really, we really don't see a conflict between the two. If you're looking at long-term sustainable returns, you have to sort of be on the side of sustainability.
Philip, is it true market players tend to... Go ahead.
No, I think that's exactly right. I can give you another way to look at the data. If you, we've looked at a world where, nothing much happens in terms of mitigating climate change. That world would generate a loss of global GDP of something like 20%, 25% over the next 20 years. You can see very quickly once you do the math and once you kind of look back to what that means for companies, for sectors, for countries, and ultimately for portfolios, that's a very bad world to live in, right? From any kind of investment perspective. That's going to mean dramatic losses on balance sheets, dramatic impairments on assets, dramatic losses in national accounting schemes, but also in portfolios. And so there's no doubt in my mind at all that successfully transitioning to net zero is a much better place to be for a global economy, for humanity, of course, for countries, for sectors, and for portfolios. And that's why I think this conflict, certainly on a risk-adjusted basis, as Rohit said, if you look at it over time, it just doesn't exist. On the contrary, I think we would not be living up to our fiduciary duties vis-a-vis our clients if we simply said, well, we're not going to do anything because there may be some trade-off in the short term. I think what we need to recognize, and this is the hard part about it, like any other major transformation of the world economy, and this will be perhaps the biggest one the global economy has ever undergone. But think of similar ones: the introduction of China into the global economy over the last couple of decades, technology and what that has meant over the last few decades. Whenever you have these vast transformative forces that hit the global economy, there are going to be many losers and winners. So this is not going to be pleasant for everyone. And the key is adaptation, which is why this transitioning piece is so important. And our role as investors is to find a way to help our clients to navigate this period where there will be lots of relative changes of prices, lots of winners and losers, how to best navigate that in a fiduciary sense on behalf of our clients. That's our task that we have set ourselves, and we're convinced that it pays to think in terms of sustainability over the next couple of decades from a portfolio perspective.
Actually, if I can just
add. Linda, can I jump in 1 second?
Yeah, go ahead.
Just to kind of help frame this, I mentioned urbanization in cities earlier. We did a really interesting piece of economic work where we looked at 60 emerging markets and the fastest growing cities in all of those markets. And we really believe that the opportunity for investment in those cities is something like $29 trillion to actually make green cities. It includes buildings, housing, transport. So there is going to be massive opportunity is going to shift. And Philip's right, there are going to be winners and losers. And I think one of the obligations of the multilateral organizations, especially the public multilateral organizations, is helping the losers so that we actually create what we call GRID. You said build back better, but a green, resilient, and inclusive economy. So how do we help, coal miners actually get new skill sets and be able to find jobs where they can function in a new economy?
I want to take a question here from Olivier, and this has to do with returns. Philip, Rohit, perhaps you can chime in. Do you think that looking for 15% annual returns is sustainable, especially in a world of low single-digit bond returns? What would be the typical annual return target for sustainable investments?
Look, I mean, the way I sort of look at it, I don't sort of say that there should be a separate target for sustainable investments versus a target return for other investments. In a lower return world, if you have low returns across the board, yes, your sustainable investments will also have lower returns. I think the point is that they should be no lower than what you see in any other investments. I think that's the key point we've been trying to make. And I think there's some difficult decisions to be made out here, because very often we come across companies who say that they're operating in markets where if they want to invest for sustainability, they're not going to get paid for it, and they're not sure they're going to get the returns. Particularly in emerging markets. I mean, let's say you want to set up a green building. You may not have clients willing to pay for it today. And so the question is, should I incur a higher capital cost? But if you then take into account the fact that you could have a lower cost of capital from investors who are looking at more sustainable companies, you could have be a better employer and attract better employees who are looking for responsible companies. And you could have a better customer franchise and build your brand around customers because you have a green outlook where your competitors don't. Suddenly the payback period may not be as much as what you thought earlier. So I think you have to look at it from a longer term lens, but there are also, from a capital market perspective, from an ecosystem perspective, shorter term intangible benefits, which could actually give you a competitive edge. So again, we strongly feel, and we're encouraging all our companies not to think of this as a trade-off, because for them to succeed in the long term, they have to follow the path of sustainability. And they'd probably be surprised at how early they're rewarded by the markets and other stakeholders if they go down that path.
Yeah, I would very much second that. I mean, the key, in a way, the foundational premise behind our pivot to sustainability is very much fiduciary, and it's simple in a sense. It's this conviction that we're going to see a tectonic, Larry Fink has called it a tectonic reallocation of capital towards sustainable economic activities and practices. And from that, it follows exactly as Rohit said, that the cost of capital will change, right? Those who are on the receiving side of this capital will end up having lower cost of capital. to operate with, and those who refuse to acknowledge will end up having, in the worst case, stranded assets at their hands, or in a kind of intermediate sense, at a minimum, for some time, will have much higher cost of capital, which will make it harder for them to operate successfully. In addition to that, you then get into all the things that some of them Rohit mentioned in terms of, attracting talent and having a franchise, having brand value. All these things come on top of it. But I think that the foundational finance piece of this is really around the shift in capital and therefore changes in the cost of capital, which would suggest very clearly that in the longer term, it will pay to orient your portfolio towards sustainability.
I want to touch on, at this point, carbon taxes has been pretty controversial. Stephanie, maybe you can chime in here. There's a question from Michael Buchanan from Temasek. Hi, Mike. How important are border carbon taxes in encouraging earlier adoption of a meaningful carbon tax? Will they risk increasing protectionism?
So it's a very interesting question, Haslinda, and I'm actually quite worried about some of the border taxes that are beginning to be developed, especially in Europe. If you look at global trade, it's already been hindered by protectionism. It has, over the past 75 years, pulled 50% of the world's population out of extreme poverty. We need global trade. And if you look at the requirements that the Europeans are putting in place, as an example, Africa won't be able to trade with Europe. So I do think we need to go back to the notion of how do we actually create carbon offsets and carbon credits that would be beneficial to us and encourage both private companies and financial institutions to begin to invest more in climate friendly projects and avoid the protectionism that will come from border taxes on carbon.
Philip, would you like to chime in on that?
Yes, I mean, I think the reality is we're going to see some of these taxes because we're not going to have, carbon taxes being introduced everywhere to the same extent in the world. This is a huge coordination problem. So do I worry? Yes. I think there are ways to tackle it. And one of the suggestions I've made in the past is the OECD should get involved here and as a kind of standard setter in terms of a global taxation regime, so that you can prevent these border adjustment taxes kind of being used as a front really for purely protectionist purposes. So I think we need to tackle this, and it seems to me the OECD is well placed, given the work it has been doing as an institution around global taxation rules, to address this very quickly. I think we have to be realistic. There are going to be border adjustment taxes in a world where not everyone is going to have carbon taxes. So I think that's the inevitability of it. So we need to find ways to set standards there as well. And luckily we have this, the OECD has done important work in tax coordination before in other areas. So I think there is hope for it, but it has to be taken seriously.
We have about 2 minutes, and I have a couple of questions more from our participants. Rohit, your thoughts on this? What are the barriers stopping multilateral institutions from doing what has been suggested by the panelists? What must change in these organizations, and how feasible are these changes?
Look, I guess Stephanie is probably better equipped to answer what's stopping multilateral institutions.
She's next, Rohit.
Look, I don't really have a good answer for that. I'm sure they're sort of trying to address these issues. It's quite clear that they have a role to play and are engaging with governments to try to address it. But I personally don't have a good answer to what they need to do to be able to do what they can't do today.
We defer to Stephanie then. Stephanie, your thoughts?
So, Haslinda, I think I might have said this earlier, but the bank group is the largest lender to climate-friendly projects in emerging markets. $83 billion over the last 5 years. We are really leaning in. Our latest climate change action plan, which is what we're going to do over the course of the next 5 years, commits us to doing at least 35% of our business in and around climate. We've also committed to be fully Paris aligned. So we're moving the institution in the right direction. But I actually think what we need in relation to the multilaterals and the private sector who are trying to have conversations about how are we all going to intercede, because we know there's no fiscal space left. The private sector is going to have to step in, and it's going to have to step in big in investing in sustainability and emerging markets. So I think what we need is better understanding of what are the needs and concerns and issues of each of the different kinds of institutions that can play. And then we can find a path forward. Some of the things that have been suggested, like change the charter of the IFC, change the charter of the World Bank. I don't think that's necessarily going to help us. But what I do think is that we can use the strength and convening power of institutions like the World Bank Group to actually create new vehicles, new ideas of how to channel money. And that's really where, if we can all get together and focus in a positive direction, we can make a difference.
And on that note, we have run out of time. Stephanie, Philip, Rohit, thank you so much for your insights today. Thought-provoking.
Thank you, Haslinda. Thank you.
Thanks, Haslinda.
Bye, everyone.
Bye.
Absolutely.